Well, good afternoon. My name is Chuck Evans. This is our monthly 30 at noon webinar series with my friend David Tinsley and Cory Jones from Lumos Data Analytics. Today, we're going to touch on a very few couple topics. One's going to be lender service providers and how it relates to Office of Credit Risk Management. Two, Lumos put out a great white paper last month, was it, Cory?
Yeah, a
And
couple weeks
we're,
ago.
we're going to chat about that. My friend Ethan Smith was on a great podcast with Nagel, and we're going to bring up some of the topics that he addressed: change of ownership, franchise lending, immigration status. So we have a full topic here. So let's go ahead and get started. I think there's probably 94 lender service providers on the market. There's only a half dozen of any size, but the SBA, through the Office of Credit Risk Management, has moved, albeit indirectly, the oversight of these lender service providers through their client banks, and that's caused some good, and that's caused some angst. David, you want to share some of your thoughts on what's happening today as it relates to lender service providers?
Yeah, thanks, Chuck. I think if it's been a while since you've had an LSP agreement approved, uh, even that language or wording itself is now specifically very different than it used to be prior to, I guess, January of 2024, when that responsibility shifted to OCRM. They in standard fashion, there's a checklist associated with it now that you want to go through. There's some certifications to be done, and a process that I will say the benefit of that is it's certainly much faster to be able to submit it and get a
For sure.
response for an acceptance on SBA's part, so that you can go ahead and begin working under that new agreement. But if it's been a while since you've had that approved, you may not be fully aware of the extent to which those changes are expected. And one of the things I would definitely recommend is if you haven't seen the submission checklist that goes along with that process, it would be worth just reaching out to SBA to get a copy of one of those just to appreciate it. Because if OCRM is going to be coming and looking at how you're interacting with the LSP, they're expecting certain risk management policies to be in place, sort of governing that relationship and clearly demonstrating the oversight that the lender has of the 7A program, especially in working with a vendor like an LSP. I would anticipate, if you are working with an LSP today, if you have not heard from OCRM, you likely will at some point, probably sooner than later. And it doesn't necessarily mean it's because you're doing large volume. It's simply because you are working with a vendor in your SBA program. And to me, just reviewing sort of that certification that's expected of lenders is definitely worthwhile. Uh, and it'll give you an idea of what it is that OCRM's looking for. And these are straightforward things. Nothing is new in terms of this is new requirements that were set forth in SOP. I don't think those were materially changed. Chuck, you may correct me on there, but I believe those are largely the same. And so really, it's more about taking those requirements, putting them in sort of a checklist format, and then how that impacts really what, let's just call it, vendor management policies that a lender has. That's really it's about looking at how do you have policies in place, and how you interact, and how do you test those policies, or if you're having some sort of an oversight plan, what are you doing to demonstrate that oversight? Anyway, I think the great place to start with that is just to get a copy of that checklist. I imagine if
Perfect.
we can certainly help. This is not. I think this is probably publicly available. I don't imagine there'd be difficult obtaining a copy of it to be able to review it. But it's definitely, if it's one of those things that you've been meaning to do, I would say go ahead and do it to definitely prepare for it. It's a lot better than getting a letter. You got 5 days to respond, or however that looks. And scrambling to do that. Those are, I don't know. Chuck, what do you think?
No, that's good. On that certification, they asked for someone in charge of vendor management to acknowledge the
That's right.
certification, along with someone on behalf of the lender, which is new. They want to make sure that the bank has vetted that third-party vendor and it's gone to the board if that's required. So it's a lot to do. We have a
Mhm.
quarterly LSP call with Office of Credit Risk Management and Nagel. And the purpose of that call is to talk about some of the things that we've seen in the industry that may be unfavorable. I mean, we have 94 working in different ways, and basically we're an unregulated group of vendors. And we've seen some things like some LSPs managing the client's money, taking in payments and then moving it over to the client and things like that. So we want to make sure that our industry is operating between the white lines, and this is just part of OCRM's desire to see what's going on. They'll never approve these agreements; they only review them. Right?
Mhm. That's
Awesome.
right.
So that's a little bit about LSPs today. Let's talk about another great report, the Lumos Data Analytics report on the state of the industry. Cory, do you want to talk about that white paper?
Yeah, thanks, Chuck, and thank you for having us again. We're really
Sure.
excited to be here. So we put this white paper together mainly because of, if you caught the last 30 for 30 that I was 30 at noon that I was on, we really discussed kind of the actual data behind default rate increases, but we didn't actually go into why. And I know there's many narratives on why SBA default rates have increased, and I'm here to tell you that we can't really support one single narrative. It's a mix kind of all of them. So if you're going to check out this white paper at our website, the main page I would draw you to is the synopsis. That literally tells you what we tested and what the results were. So overall, we tested 5 different, I guess, narratives or theories that we could find in data to see how they impacted SBA default rates. The pandemic stimulus impact, recent loan risk, so are loans just more riskier due to program modification changes, lender type and risk, and then also interest rate impact. So those are really the 5 key things we tested. And it really came down to, and I'll go a little bit deeper. I'm not going to go into the weeds for this session, but the increase in the SBA loans for 2024 is not a simple issue. We were talking before we even started filming today. It's a mixture of stimulus aftermath, rising rates, policy changes, macroeconomic conditions. And 2, we were talking a little bit just about competition. I mean, in 2024, there were as many SBA loans, from a volume and dollar standpoint as we've done, except for in 2022, I think there was more dollars due to kind of the 90% guarantee and some of the 6-month payments like we talked about. But Chuck, I think probably the biggest thing that is, when I was looking over this analysis and all the great work that our data scientists did, was that we are inherently doing slightly riskier loans. So we actually took the loans that were produced in 2024, ran those in macroeconomic environment of 2018 to see how they would perform. And they actually were slightly more risky than the loans in 2018. The interesting thing is, when you look at the breakout between non-bank lenders, credit unions, and banks, non-bank lenders actually had the same amount of risk across time. They've just gathered a larger market share. So increasing that risk a little more because they do have higher risk inherently than banks and credit unions. But banks and credit unions actually did increase risk a little bit overall in 2024. And I think that kind of speaks back to some of that competition piece of it. But yeah, I'd love to hear y'all's opinion. And when we go to these conferences and I ask people, hey, did you make any changes based on the August 2023 program changes? And I don't think I've ever heard anybody say, yes, we made wholesale changes because of that. So it is a competition, but something was driving slightly more risky deals.
Well, and I think it's still the 80-20 rule, or 75-25, where 20% of the lenders are doing 80% of the volume. And if I recall, and correct me if I'm wrong, Cory, that year over year we had less lenders in the program than we did the year before. Am I right? So
Yep.
that small 20% did more volume, and we had a few that dropped out.
Yeah. And then just the last thing, we really did find that the pandemic stimulus did artificially suppress default rates. I think we
It
talked
had
about
to.
that
It
last.
absolutely had to. Yep.
Yeah. And we talked about that last time. I think a lot of the losses we know a lot of the losses from 23 and 24 are a catch up from loans done in 18 and 19 that really would have never even made it that far if it wasn't for all the stimulus and everything that went on during the pandemic.
I don't know about you, but if my mortgage went from 6 to 11%, I would struggle.
And I didn't even hit on that. That is the fifth. I mean, I
Yeah.
mentioned at the top, but when we obviously found that is a huge risk, right?
Mhm.
That's been a big issue. we used our portfolio score, and when we're running that product for banks and credit unions, financial institutions, almost always the number one feature of risk in that model is current interest rate, because
Right.
you just said,
Right.
Chuck, that these weren't originated at 11, 12%. They're originated at 7, 6. So yeah,
Well, and we talked about that the last time Okra was at a conference. Emerging risk is the concern, and what are you doing about that emerging risk as a portfolio manager? David, have you done anything differently over the last couple of years as a result of the loans that you're seeing with your clients?
Well, yeah, I would say we definitely had to change what we viewed in terms of what we used to call stress testing. I mean, no one
Yeah.
envisioned a rate increase. I mean, used to 200 basis points was considered extreme,
Hmm.
not that long ago, and then we found out that was nowhere near enough. So yeah, part of it is how close is it based on that rate, and then can you absorb a change? I don't surely know. No one anticipated it then, but then at the risk of sounding like we're repeating ourselves, no one expects that again now.
Right.
Uh, you know, so there's obviously some. I would think the natural reaction to that is to see some tightening of some credit boxes. And Cory, I
Hmm.
kind of want to jump back and talk about what you were saying, that no one necessarily changed their programs as a result of August of 2023. Maybe they didn't in terms of the loans they were choosing to do, but I am curious as to how much changed in the way they were doing those loans
fair.
as a result of some of the loosening of
Big.
some guardrails, if you will.
Yeah.
And as a result of that, because I know the difficulty, and everyone who has been a part of a journey of trying to close that SBA loan that just won't close because there's something else new that's discovered, something changed, this came in under, or just whatever the case may be. I imagine there's probably some level there that some of those loans got through that might not have otherwise. I do wonder about that. If maybe that's contributed as well. I don't know how you would even begin to put your finger on that and be able to total it, but that's just conjecture on my part.
Well, that's kind of, I mean, I think that the part of the analysis where we took the loans done in fiscal year 2024 and actually said they would have been in fiscal year 2018 using all the
Right.
same business and credit factors, but using those macroeconomic factors and finding that the business and credit factors were more risky than the ones that were
Right.
produced in 2018. That speaks to everything you just said.
Yeah, you may. I think you're right. You're right. That's a
Yeah.
good point. No one did it on purpose, but they
No.
did. Exactly. Uh-huh.
We were talking about emerging risk in the portfolio. And Cory, I know this is a commercial for Lumos, but I'd like to learn more about the portfolio scoring method that you guys use.
Yeah, so it's what we use for this analysis. So essentially, financial institution sends us their loan tape every quarter. We
Hmm.
score that for the next 12 months of credit risk. And then you can have that at a loan level detail, an industry level, geography level, county level. And it really just has helped lenders identify areas of credit risk in their portfolio and really be prepared for what the next 12 months are going to bring. We've got a few folks that are incorporating it into some of their CECL modeling and reserve requirements. So it's really can be used across the board, but that's really for those portfolio managers every day who are trying to figure out which parts of the portfolio should I focus my time and energy on with kind of a limited staff of relationship managers.
Great tool. And the SBA's new Redwood score, too, coming out that's proprietary, which is much
Yep.
better than the prior scoring system, as I understand it, according to Office of Credit Risk Management. So those are some really good tools that we can monitor performance and try to get ahead of things before they get out of hand.
Mhm.
Well, let's move on to a couple good things. We Ethan Smith coined the phrase. I think he said, it's been do what you do up till since August of 2023. Maybe it's do what you should do. And the tides are changing with the new administration, certainly. That there's some really positive things. But one of the things that came out in December was the change of ownership. And I thought that was one of the best things that I'd seen, because if I'm selling a business or I'm buying a business and I can leave that seller in there at a small percentage, that mitigates my risk. David, I don't know what your thoughts on there, but that's one of the good things that I've seen in some of the changes.
Okay, completely agree. And that's funny. So when you see the partial change of ownership being introduced, the thing that I was looking at was I'm recalling all of the deals where someone who had sweat equity in the business but not actual
Mhm.
equity,
Mhm.
they'd been a major piece of it, and but they had not amassed enough resources to be able to meet the 10% requirement to do a complete change. Um, and so I watched that struggle so many times, realizing that something like a partial change was a great idea. Uh, but then at the same time, you watch these deals that go through and you see the owner exit, and there's definitely a different mentality of handing over the business and then kind of not worrying about what happens after that, versus there is something to be saying, I still got a foot in the door, or I still, I mean, there's a piece of this that I want a legacy to continue here. And it really does change. There's things like, do I let maintenance continue to get deferred, or do I make sure I'm pointing out this other item over here that we need to worry about, because that's a potential problem that really new owners often just had no way of knowing about if it wasn't a seller who was actively trying to disclose. And again, and not attributing motives to anybody. It's just natural human, I think, behavior to focus on helping getting this transaction done, because I'm out the door when we're done. Like, why wouldn't you want to have an agreed upon? I've got the person who built this 20 years in the business doing all this. Wouldn't you really want their wisdom to continue? That just seems like such a great way to go about it.
Why would you want a full change of ownership unless you just
Yeah,
really wanted to get rid of the person? But that just makes sense now. It's
agreed.
one of the really good things that have come out of the
Oh,
regulations
agreed.
in
It
December.
it opens a true opportunity for a long-term transition. And that's really what you're looking for, because that gives you the stability.
Had Edith Wiseman on last month, I believe, and talked about franchise lending and some of the challenges that new lenders are seeing in trying to understand how to move forward without the directory. I know Nagel had said the other day they thought maybe we could get the franchise directory back, and I'm sure many lenders would be happy to see that. Thoughts, you guys?
We would love that. Yeah. It'd be great for
Yeah.
us from a data aggregation standpoint. I mean, we're currently, I'm not sure if you were phrasing that to me, Chuck, but I mean, we're currently using some pretty intense algorithms to try to match all that together to pull franchises. So we'd have better coverage than we do today.
And it's given the SBA attorneys some extra work, but I don't think they're too excited about it. But David, any thoughts on the franchise lending? Anything, uh, addendums, and lots of the franchise boards aren't wanting to sign addendums and things like that? Have you had experienced anything like that?
Yeah. Well, so I haven't seen that directly, but I definitely was thinking about that. Listening to the podcast that you referenced, where Ethan had mentioned the fact that sort of SBA created the scenario where it benefited the small business owner coming in. They had that benefit of SBA says you must sign this or offer it in this way or you can't get it. And that was very pro small business owner, just in terms of being able to have that leverage. And so I I think there was the note that was sort of slipping, because that's not strictly the same requirement that it used to be, and their willingness to sign an addendum as it had been, whether or not they're making some edits to things. And so that leaves it in the lender's hands. And obviously there's always a concern that did that push it into an area that really questioned eligibility at that point. Because that was a lot more fuzzy. A lot of us prefer to have the guidelines. A lot of us like to have the very clear set rules that if you do A, B, and C, you're good. But now it's just make sure you're doing the right thing, and that's so much fuzzier, than it used to be. So I've seen a hesitation on the franchise lending piece of it, especially for anything new. But I mean, Edith was kind of bringing that up. So yeah, that's certainly that is a to be understood.
I think it's even gotten to where the franchisors are looking for new lenders to help them with expansion.
Yep,
So, as a small
that's
community
right.
bank, if we do it right, we can introduce franchise lending on a local level versus on a national level. So it could be an opportunity
Yeah,
for
that's
some
right.
of our clients or community banks as a result of
Hmm.
this. Okay, we were at the last conference, and we talked about an hour, maybe an hour and a half, on immigration status. David, can you share a little bit about some of the challenges that have come up as a result? And the reason I say that, I was talking to a good friend of mine who was looking at financing ESOP and several hundred
Right, right.
employees, and the angst that's caused now and those processing. I'm hoping that we're going to have a resolution to this. What's your thoughts?
Yeah, I hope so too. is my thought, Chuck. Yeah. So the difficulty that we're facing there is that it's not clearly defined. And I know I'm not the only one who immediately saw that concern, but it made reference to the fact of beneficial ownership as it is defined in 5010-7-1, which I immediately flipped through there and said, I must have missed that. And I read through it and I thought, am I the only one who can't find where this was supposedly defined? And so that does make it quite difficult because, again, as most lenders are trying to simply do the program correctly, they want to follow the rules, and kind of understanding that without, in absence of being able to clearly define what this means, it's not the FinCEN definition of beneficial owner. And so really what it comes down to, you're kind of left with the reverse of kind of piecing together that anyone who benefits from ownership of this business cannot be outside of this very set category of, U.S. citizen or national or the LPR. And if that's not the case, then in theory, any ownership at any level disqualifies this loan. And so yeah, it's a very different thing. I mean, it's nice that E-Tran is setting this. You got to at least get it to 80%, but you still, as a lender, supposed to be certifying that there is no beneficial ownership. And I mean, I think
and
that's
the due diligence to go through that's scary. Just
it is. Yeah. I mean, there's definitely some hesitation.
well, Jane Butler said something about maybe the
absent.
1919 and the new 1919 having each borrower fill out the 1919. That might be a solution. So time will
Yeah, I
tell.
will. And it gets back to whether or not, well, is the SBA okay with the lender relying on that certification? So if the 1919 clearly spells that out, there is a certification that there's zero beneficial ownership, under those circumstances, does that mean that you're good? But it's always going to come back to the lender should never submit a loan they know isn't eligible. And so, like, what's the?
Exactly.
And it's just, I think we're going to need guidance on that.
Well, what other hot topics have you heard? You guys have anything else before we move on? You can think of compliance driven, anything? Cory, where can I get a copy of your white paper?
Lumosdata.com, Chuck. It's in the resources tab. You can download it there. We do ask for an email, but I promise I'm not gonna bug you. It's really just to see who's downloading and see all the interest. It's been really interesting. We've had a mix of multitude of different industries and government and just really across the board that have had interest in the white paper.
David, any final comments for you?
No, I think it's really coming back to with the anticipation, especially from the administrator, saying that the sort of rolling back of the do what you do. There seems to be a greater interest in how did we used to do this, and so there's been because we don't know that that's where we'll land. We just know that at one point that was considered reasonable. So it's sort of calling into a question a lot of the steps that I've seen us take, and when I say that, I'm meaning lenders in the industry. So we've had some interesting topics. I've certainly enjoyed, even with this most recent conference that you made reference to, the being able to sit down with other lenders and saying, what are you doing? How are you handling this? If iron sharpens iron, that really definitely was some benefit there. So I like the idea of being, whether you're being involved in some of these organizations, whether it be part of regional committees or even just attending. The kind of call like you were describing there, Chuck, with the various LSPs getting together with Nagel and OCRM. It's just a lot of benefit to kind of joining together in large discussions.
I'm pleased we've had a lot of activity of us helping review loan policy. And
Yes.
we've kind of steered them back to the prior SOP to make sure that we're staying between the white lines. So it was
That's
a
right.
good move. Breaking news. Cory, what did you just read?
Yeah, so Chuck, we just came across a new SBA notice. So SBA guarantee fees have been increased. So for loans $150,000 or less that exceed 12 months in term, 2% of the guaranteed portion, the lender may retain no more than 25% of the fee. For loans $150,000 and $1 to $700,000, it's 3% of the guarantee, and for $700,000 and $1 to $5 million, it's 3.5% of the guaranteed portion. Up to $1 million, and then 3.75% of the guaranteed portion over $1 million.
David, I don't know what you guys think, but we should have gotten back to that earlier because we are operating in the red, as I understand it, or we are. And so now it brings it back into the black. So that's actually good news. It's good news.
Yeah. The last thing, Chuck, on short-term loans under 12 months, 0.25% of the guarantee portion. That was
Okay.
just the last piece.
Hot off the press. Thanks, Cory.
Yeah.
All right. Well, this has been a good 30 minutes. Next month, April 17th, we're going to have 4 guests, and it's going to be 2 successful certified development companies and 2 SBA managers. Brent Cherlino, former OCRM director and at Velocity SBLC. Michael Johnston from Bankwell runs that SBA department. My friend Hilda Kennedy from Unpack Business Capital, CDC in Ontario, California, and Manny Flores from Summer Corps in Illinois. So they're going to talk about their vision for the rest of 2025, what keeps them up at night, and it'll just be a good conversation. So hopefully we'll see you on April 17th, and I want to thank everyone for joining us today. Thank you, guys.
Thank you.
Hey, thanks, guys.